Hello everyone, welcome back to the 29th episode of the 2026 Portfolio Challenge series. And this week we are a bit higher than last week in the main portfolio. Our deep value has not changed at all, and our meme stock is down a bit more than last week. So our main one is at 137k, our deep value is still at 124k, and the meme stock is down. Disclaimer, this video is not financial advice. In today's itinerary, we're just going to go over my no portfolio changes and why I did not change anything, some quick recap of my investing method, some of the watch list and macro news, not much macro news, mostly just watch list, and I might go over the portfolios at the end. We'll see how long this runs. This is going to be a pretty long episode. So first off, portfolio changes, none. And in the main portfolio and the deep value, those don't change too often. But in the GameStop covered calls when the meme stock won, you can see here that I did not do anything. And here, I'll even show you in the alpaca itself, the meme stock portfolio, I did not do anything. I am currently not holding any short calls. And the reason for that is because I think that GameStop is going to be significantly more volatile next week. And so I think with the low price and the low volatility, I would have gotten maybe 2K total. Yeah, roughly 2K, but my strike would have been 22. And I do think that GameStop, here, I'll just show you. GameStop is at 21. Oh, it dropped to 21.17. I remembered it being at 21.30. But yeah, so I think GameStop is going to run, and I think volatility is going to increase, and I'll talk about that pretty soon. Yeah, we'll talk about that in a sec. Actually, you know what? GameStop, why do I think volatility is going to increase? So GameStop's expected to give a tender offer within the next week. So they were actually planning on giving a tender offer. This was supposed to be today, actually, on Friday. And they do own 10% of eBay currently, so the tender offer is on the table, and when they offer it, they're going to offer it directly to shareholders. So what is a tender offer? So the tender offer is that GameStop is more than likely going to offer shareholders directly the opportunity to sell their shares of eBay at $125 per share to GameStop. Now, why did that not happen this week? That did not happen this week. That did not happen this week because Ryan Cohen said, I think it was Thursday, he said that he's going to wait a bit because some new offers for the cash just showed up this week. Now, how true is that? I'm not sure. I think it is going to be true. And of course, the tender offer does have to stay open for 20 business days. I did not say that. And GameStop can extend that if they want, but they cannot shorten it. And at the end of the tender offer, if they own 90% of eBay, so if people or institutions decide to sell GameStop their eBay shares at $125 and GameStop ends up with 90% of eBay, then they get the entire thing and they can just merge eBay. Now, if they get 50% of eBay, then they can gain technically control of the board due to shareholder shares, and then they can vote in Ryan Cohen as the CEO, but that'll take a while. That's not a direct thing. So I think that once they come up with a tender offer, GameStop's going to soar, eBay's going to soar, and there's going to be a lot of volatility. And so I'm going to keep holding for that. If it doesn't show up this week or we get another postponed this week, then I'll continue with the poor man's covered call strategy. But for now, it's just very low price. You know, GameStop, I think, is worth $24, $25. Just their cash right now, they've got over $10 billion in cash and investments, and their market cap is at 9.5 billion. So I don't know. I think GameStop is undervalued currently. It's basically valued at just its cash value. So at 21.20, that's a bit dangerous for me to start selling covered calls. But I do think GameStop is a buy, and I'm not going to do it in my main portfolio, but for the poor man's covered calls, I do like GameStop. So now the watch list and macro news. So there was a nuclear expo meeting with Trump today, and basically what he was saying, actually Oklo did not take part in this, but Oklo is one of the more volatile uranium stocks. But basically Trump was saying that he wants to push forward with uranium, and he's basically offering all the big uranium companies, all the big reactors, he's giving them leeway and runway to start doing their testing. And so Oklo came out a few days ago. Okay, so this was just a day ago. Oklo came out and they basically said that they received authorization for their grocery reactor, and so they're going to go on the first step to criticality. And this is not just Oklo, this is basically all of the uranium companies. So NuScale, CEG, all those, they're all going to be starting their tests, you can call it. So I think that is very bullish for uranium, because if and when actually these small scale reactors come online and people see that it's viable and that there's not radiation, I think the big companies, the data centers, are going to want them nearby so that they can have localized power, because uranium is incredibly efficient. So that happened with Oklo and the GME tender offer. And basically the entire video right now is going to be just earnings and talks about earnings. But first, I do want to talk about how I do my earnings again, how I project my prices, my price targets. because we are entering the thick of the earnings season with all of these coming up this upcoming week. So I'm going to use Celsius as an example because I think that it has exactly what I need when I want to show how to do this stuff. So that was a bit of a ramble, but here we are with Celsius. You can see here Celsius. So what am I looking for? First off, I like to use stockanalysis.com. I think it's easy to use. I think everything is very copy pastable into Excel by yourself if you want to use it. But basically, what do I care about? So I care about the revenue. I care that they're growing revenue, ideally very fast, because that shows that the company is growing, and I like growing companies. Additionally, I like profitable companies. So both the gross profit and operating income should be profitable for the most part. Now, this is with a caveat that I do not look at other operating expenses. So basically, I'm not looking just directly at operating income. I'm looking at the gross profit minus SG&A, basically. So this is the standard operating expenses. Now, why don't I look at other operating expenses? That depends. Sometimes I do add it in after I research it if I see that the company looks good to me overall. But basically, why don't I add it? Because other operating expenses oftentimes with these growth companies is that it's them buying other companies. So this is the payment for another company. So it's not that the money is going nowhere. It's that they literally just bought another company. In the case of Celsius over here, the 246 and the 80, this was when they bought Alani Nu and Rockstar. When we're looking at ELF, so ELF actually did not put this in their, ELF didn't even put it here, but it did show up here. I'm not sure why it's not showing up on stockanalysis.com, but this was when they bought Rhodes. Now, Rhode is a huge company. It's one of the best makeup brands right now, the best growing makeup brands in the world right now. So I don't think that ELF should be penalized for buying ELF, and I don't think that Celsius should also be penalized for buying Alani Nu and Rockstar. And so I just don't look at other operating expenses. Now, from there, what do I care about as well? Obviously, I care about the shares outstanding because that's going to be the price per share, right? That's what we're buying. So I'm trying to initially find the market cap, what I think the market cap should be. And then I'm going and I'm finding how many shares there are. And then finally, I also care about how much cash or debt that they have. So if this is a positive number, that means they hold positive cash. If it's a negative number, it's negative cash, which is debt. And so I do care about that. Why do I care about this? So first I'll show you my formula for this. And the formula is basically, I am looking at the trailing 12 months from the point that I'm looking at. So if I'm looking at 1 year ahead, I'm looking the entire next year technically, right? This would be the entire upcoming year. So I'm looking at the trailing 12 months income based on Wall Street's revenue expectations. So these are all Wall Street revenue expectations, and this will be the trailing 12 months for each of them. This is a moving average, basically. And so I'm looking at the trailing 12 months income. I am multiplying that by 20, and I'll explain where 20 comes in a second. And then I'm adding in the net cash. Now, why does net cash not get the 20 multiplier? Because it's cash. I am not going to give cash a multiplier because I can just buy treasury bonds or something along those lines and get 1.05. And these companies are, for the most part, doing the same thing unless they're doing share buybacks, in which case they're buying their own shares. So I separate the cash from the value of the actual company. And then I give the actual company operations, I give that a 20 initially, and that'll move. That goes up to 30 with me, and it drops down to even 12, I think I've given a company. But where does that 20 come from? So that 20, that comes from, essentially, I'm using the S&P 500 long-term past 10 years average PE ratio, but that also comes from somewhere. And where does that come from? That comes from how much investors get back in dividends and share buybacks from the S&P 500. And then that's divided by the rate of return. So the rate of return is basically how much return you can expect minus the risk-free rate, which is roughly 4.5%. So the general calculation right now for the S&P 500 is roughly 70% buyback and dividends, which is a ton. 70% divided by 8.5 minus 4.5, which gives 70 divided by 0.04, 0.7, sorry. And that gives 17.5. And so this is roughly what we can expect. And obviously this is going to change based on the number here. Over the past 2-3 years, this has actually been closer to 80%, which I believe gets us pretty close, I think, to the 20. That's actually exactly 20. So that's where the S&P 500 20 comes from. And that's also what I'm using initially. And then if I see that the company is growing significantly better, or I can read about the company and I see that they're going to grow long-term quicker than the S&P 500, in my opinion, which is why I like to see revenue increases. What's going on here? Oh, yeah. That's why I like to see revenue growth, because that means that they're growing faster than the S&P 500. Generally, I'll give these companies a bigger value. And specifically for Celsius, I am being very conservative by staying at 20 because it's already significantly higher than the current price of 27. So this is a 100% upside that I'm expecting for Celsius, for example. So that's how I value stocks. It is not perfect. This is very much tech-based, I think, over the past few years, but it has allowed me to catch Celsius. It's allowed me to catch ELF, even Shark Ninja last year. It got me that one. It got me Micron when it was early. It got me SanDisk when it was early. And yeah, it is kind of like a forward PE ratio. I think it's better than a forward PE ratio, but again, that's why I use it. And again, I have an issue with PE ratios personally, because taking a look at, like, for instance, Google's PE ratio this year. Okay, yeah, sorry. It was Google. Google's PE ratio, their EPS for this past quarter, and you can see here, if we go here, like to look at it like this, yeah, you can see it was estimated at 2.87 for the earnings, and it was at 9.11, and PE is just price divided by earnings. So Google has an artificially lowered PE ratio right now because of this 9.11. Now, why is this 9.11 so high? Because Google, in their earnings, they take into account their investments, and they are heavily invested in Anthropic and in SpaceX, which are both significantly higher than they were the previous quarter. So Google took that into consideration and added that to the EPS. And so now their EPS is inflated. So their PE is inflated, which is why I don't like using PE, because operating income, SG&A, you can't lie about that. That is literally just gross profit and how much money the company is actually spending. Okay, that was kind of long, but that is fine. So let's get into my earnings. Google. We were just talking about Google. So Google earnings, they had earnings this past week. The current price is $320. My new price target is $350. It was roughly $330 beforehand. Nothing special about the earnings popped out to me. Their cloud growth was 82%. I actually expected very high cloud growth. Their CapEx was huge. I expected huge CapEx. And then I also here, I did note about the EPS, which was huge based on that. And let's see where I am compared to analysts. So analyst price target is $420. I am not as bullish on Google. And again, I am using probably a lower multiple than they are when they're doing their analysis. Yeah. Intel earnings. I do not usually cover Intel because I don't think that it's a good company long term, but the US government is in it. The US government owns, I think, a pretty large percentage of it. And it did have a double beat. And of course, I am going to root on Intel. I am never going to root for companies to fail. So it had a pretty nice double beat. Again, earnings was incredibly high. Revenue, which is what I mostly focus on, it beat by 11%. So decent beat from Intel. It had a good recovery, but it's still not enough for me. And I think that in this case, so my price target for Intel is 35, right? So I am not super bullish on Intel. I do not think this growth is sustainable in the long term for them. And their forward PE from Wall Street, I think in this case, it actually is pretty accurate. I do not get this price target from here. Okay, so next up, Love, which is Southwest Airlines. Kind of funny. Their current price is 32, and I am incredibly bullish on them. Is it 32? I don't think it's 32. Isn't Love like 45? Yeah. Okay, that makes a lot more sense. Yeah, I think they're at 50. My previous price target was at 42, and that was when Love was at 36, was the last time I did that. So they went up, I sold, they went up some more, and now my price target's higher. Is this enough for me to buy? Not really, that's only 10%, and currently I don't feel the need to diversify. I'll go over my portfolios maybe later. If not, you can just look at the previous week, but I think I'm pretty well diversified in different sectors. So the revenue is growing at a growing rate, which is what I like to see. And now that there is officially no Spirit, and it doesn't look like they're coming back anytime soon, they've been showing that they can get more profits. And so I am bullish in the long term on them, especially once the oil prices drop. So US oil, that actually rose significantly this week, again, because of what's happening in Iran. And that did have a negative effect on the stock market throughout the week. So there's that. Now for earnings previews. So from here on out, it's just going to be companies that have earnings this upcoming week. And remember, all of these are this week, which is insane to think about. So we have SKHY. So my current price with SKHY is, we can zoom out for this. My price target is all the way up here. Yeah, 470-ish. The current price is 155, but again, this is a chip or a data center maker. And for some reason, people give them the cyclicality treatment. So even Micron, which is a really good company, I think I love it. Its forward PE ratio is 6.42. Its current PE ratio is 21, which is, that's right where I want it. That's like where I like it, but I like it for the forward PE. But SKHY PE ratio is under that, and forward PE is even lower than that. And I think with this upcoming earnings, this is going to drop to around 12 or so. So yeah, it's got better numbers for the price than Micron. The only reason I think that it's getting worse treatment than Micron is because it is a Korean stock and not an American stock. And therefore it is based on Korean policies. It does have all that. And now with Korea, 10% of Korea got margin called over the past 2 weeks. 10% of all traders Not just 10% of people who took out margin, 10% of all traders got margin called. So Korea is now cracking down on margin and leverage DTFs and all that. And a lot of them do hold SK Hynix. So SK Hynix is getting punished for that. It did have a decently small run this week to 180 and then back down to 155, which is roughly where it was at the beginning of the week. But I do expect after this earnings, it's going to jump to 250. If not, I'd be very surprised. And if not, then that's a deep value play, as I like to call it. RIVN earnings. So RIVN, unlike the rest of the companies that I follow, most of them, it is not profitable and not expected to be profitable anytime soon. And more than that, currently up until the most recent funding that they did, their funding round, where they sold, it was like 750 million either dollars or shares. I'm still not sure about that. They sold that at $15.5. And so this cash number is going to be significantly higher, but the share count is also going to be higher. So yeah, still not close to earnings, still not close to being positive, not anytime soon. By the way, I hate that stock analysis is now defaulting to this and not the income statement. I hate that view. So their earnings per share is getting better. And with the RIVN R2 coming out this quarter, I am super bullish on it. I'm waiting to see how their profit margin is. So right now we can see that their margin or their gross profit margin is very low. It's around 10%, and that's just that. And that's without SG&A. So I expect this number to go significantly higher in terms of being a percentage of revenue. And long term, I do think that RIVN is going to be profitable, and I think it's going to be sooner than people think it's going to be. I like the company a lot. So we'll see. This number is going to be huge, by the way, I think. For this upcoming revenue, I can see easily 2,000, but we'll see. And so I do think within the next year, it's going to touch 20 again. I don't care that it's 15.8. It could also touch 10. I don't care. I think it's going to touch 20. And so I am very excited to see this quarter. Looking at the margin, I said that it's not lacking demand. Oh yeah, they were talking about how they've got pre-orders like all the way till the end of this year. And I think I read until June of next year as well. So we'll see. And they are trying to get refunded a few tens of millions of dollars from the unconstitutional tariffs. And I say unconstitutional because it was unconstitutional. The Supreme Court literally decided that. So we'll see. And yeah, I even wrote here, I'm curious to see the new cash pile. I didn't even look at my notes here. Okay, next up, Cinemark. Current price 33. I think I got into Cinemark when it was at 22 the first time and I sold at 28. Does that make sense? When did that movie come out? It was a movie that I literally went to see, and was it in December? No, I don't think it was in December. I think it was here. So I think I got them at like, we can just look it up. I bought them in the main portfolio, Cinemark. Oh, okay. Not that good. So 24 and 28. I thought it was better. I remember 28. I just remembered getting in lower. So I got in got out at 28, and it's been up to 35 even already. And my current price target is at 50-ish. And why is it so high? Because Cinemark has been growing revenue, and it's going to continue growing revenue, I think at a faster pace, especially with people getting fed up with Netflix and Disney Plus. And I've heard, like, even today I was at the supermarket at Trader Joe's, and I heard two people talking about how they haven't been in the theater in forever and they want to start going again. So I think that's going to start up, and I think Cinemark is the biggest cinema company that's publicly traded in the US. So I think that this is just going to grow. People miss it. People used to like it, and I think they're going to start liking it again. And this year we already have The Odyssey, and we're also going to have Dune and another movie that I'm currently forgetting right now, but it's going to be a pretty big deal this year. So I think this year they're going to have great numbers. So yeah, I can easily see 70. More than likely, it's probably going to be around 50 is what they're going to touch over the next year. What does Wall Street say? They like 35. I think 35 is too cheap right now, to be honest. This is a great company. Meta. So current price, it actually ran up this week. I thought it hit like 700, almost 700. Okay. It ran up this week, just like I thought it would. Then it ran down. The price target for Meta is 950. They have huge growth on their end. They finally have a good AI. They've got Facebook dating coming out, their ad revenue, and Facebook knows basically everything about everyone. They have WhatsApp, they have Instagram, and they have Facebook itself. So Meta has everything about everyone. And I don't see anything stopping their growth. Just look at this nice track record for them. Yeah, this is a beautiful track record. Almost every single quarter is above 20% growth from the past year, which is amazing. That's exactly what you want to see. So they've got fantastic growth, and people are scared of their CapEx spend, but Zuckerberg is known to be aggressive, and I think he knows what he's doing. He's a very smart guy. So price target of 950. I like it. That's also, I think, with the 20 ratio, just to be conservative. And even with that, it's at 950. Now, Microsoft in the numbers, it's better than Facebook technically, right? It's got more upside just by the raw numbers. But I am not as bullish on Microsoft. I think they have yet to show how they're going to monetize things better coming up. And they just need to prove to me that they can grow quicker. Let's see Microsoft here. I don't even think it's 20% revenues over the past quarter. Yeah, they haven't touched 20% revenue growth over the past 2 years. So I am not as bullish on Microsoft, especially with their AI play. They started really strong, and It's just gotten weaker over time. That again, the numbers say it. I just don't like it. And let's see how analysts are on Microsoft. Analysts say 550. Like I said, I'm not as bullish as other analysts on this one. I'm happy to be wrong. I'm happy for people to make money on Microsoft. It's just, I think there's better value elsewhere. Robinhood. So Robinhood, the current price is at 95 roughly. It did touch 116 last week, I think. It's an incredibly volatile stock. Oh, did it go all the way to 120? Almost. 119.54. Wow. Yeah, so I think Robinhood. So my issue with Robinhood is that it's priced for longer than 1 year. Now, nobody knows anything about 1 year, and I do agree that Robinhood in a decade is probably going to be the biggest brokerage in the world. I think that they are growing at an unprecedented pace in terms of users. They've got new technology and they've got everything to soak you in and keep you in. So I do like Robinhood longer term. And I think if you're a super long-term investor and you want to hold it for 10 years, I think in 10 years it's going to be a $1,000 or $500 stock. I didn't run the numbers, but I could see that happening. What are they worth right now? 100 billion? 85 billion. How much is Interactive Brokers? IBKR. That's only 40 billion. How much is Schwab? Schwab's 177. Robinhood's going to be bigger than Schwab for sure, which is going to 3x already, roughly from where they are. Yeah, so 300. I could see 300 in the next 5 years. Just I like to invest 1 year ahead of time. And, if their numbers show good profitability in a year, fine. This year, I had them at a value stock. They hit 60 and my price target remained at 90. That is fine. I will invest in Robinhood if it arises. It's just at 95. I think that's a bit expensive for me. Apple. Current price 330, price target of 300. I'd love to be proven wrong. I don't like their practices in terms of how they lock people in, their green bubble versus blue bubble. I don't like their OS, to be honest, but I think they make fantastic products, and I think that their integration within their system is amazing. And that makes for a great user experience if you're in the Apple experience. Now that they've recently increased all their prices, and I am a bit annoyed with that because I was actually planning on maybe buying an Apple computer. We'll see now. But yeah, you can see here, they've been growing at a decent clip. Over the past 2 quarters, it's been quicker. And I think this quarter is going to be like a 20% revenue growth, more than likely. I don't know. I think that they're actually going to get less demand with these prices because people were buying a lot of Apple the past 2 quarters because it was just bang for buck, the best you could do for your money. And I just don't think that's the case anymore. So we'll see the rise of probably Linux and Windows computers coming out more. Obviously, the iPhone is the iPhone. That's not going to change. Where are analysts here? Analysts are at 318. I'm at 300. I am, again, less bullish than the analysts, but even the analysts are not bullish on Apple. I don't know how that's a buy if it's under it. Never mind. Yeah, I have no clue. Amazon. Oh, this is a long one. Okay. Statement, quarterly. Yep. So revenue, not great growth. I think it's going to grow quicker from now on. I think that they know that they need to up their game a bit. AWS growth is going to be amazing over the next few quarters. Like, that's going to rock the world, I think. And that's just AWS. And I want to see their Prime numbers personally. This is for a personal online argument that I've had. And now that, I don't know if you guys have noticed this, anybody listening here, but they have Amazon Grocery right now. And it's amazing. They have fantastic prices. It's not like, it's not Walmart prices, but it's cheaper than Trader Joe's. It's cheaper than Whole Foods. And you get it to your door. It's free delivery for all Prime members. So I love Amazon Grocery. And I think that that's just going to keep expanding. And I did write this. Amazon is very unique in that they have the money and they have the ability and the manpower to dominate any sector they want. But yeah, so I am very bullish on Amazon over the next year. Let's look at year to date. Oh, it did touch that. Yeah, I think Amazon's a great company over the next few years. Again, it's not a super volatile stock, and I do like volatility. I think you can ride that with momentum. So I'm still debating how heavy to weigh this in my portfolios. But I do like Amazon. My price target is 290. Here, the price target is 313. Oh, Morningstar's is going to be 280. That's pretty good, actually. Yeah, so basically everyone is very bullish on Amazon. So let's go over the portfolios really quickly. This is a long video, I'm sorry. 2026 main, I am up 37% on the year over the past week. This is incorrect. I was at like 40% over the past week. Never mind. Here's my beta and my Sharp, Sortino. Anything you guys want to know? Here it is versus the S&P 500. And I did not make any changes this week. This is just my Robinhood. I sold a call and it was out of the money. That's fine. And here are my historical winners and losers. Micron and SanDisk obviously carrying, and then Southwest and Amphenol. Yeah, a bunch of chip stocks, Costco, Elf, all that good jazz. Here's my allocations if you guys want to see it. It's all here. Elf, Meta. And again, I do weigh by conviction. So this is not random. This is not I put 10K in and it just grew into that. I do put in more for stocks that I think have higher upside and I'm more highly convicted on. So I am super highly convicted on Meta and Elf right now. I am very high on Uranium. Micron's got a ton of growth left, etc. And then the meme stock. So this one, not much to talk about. I am still at 154 GameStop longs. As you can see, I did not buy anything. And here I have a simulation of Monte Carlo that I did. And so I input it here so I can track how I am next to it. And I am down compared to the Monte Carlo simulation. But that also has to do with GameStop stock price right now. And not just the amount of shares that I have. Here I've got that simulation over here. And then my deep value. So my deep value, this is just mathematics. I do not research these companies at all. Oh, that's